So, Todd, what makes something a good bargain if it's not just low share price?
I think that, people have to look at it and say, I love the way you just summed that up, by the way. That's fantastic. Yeah, it's like a Black Friday sale and you've just bought something for 25% of the price. It doesn't mean that it's going to last a long time. You're just getting a great deal on it. That's a fantastic way of looking at it. And I think that people need to approach the stock market the same way. If a stock gets down to $5, there's probably a reason that other people don't want to own it. What you need to look at is you need to say, okay, what is the company's current product demand? Are they raking in sales? Are their sales growing? What's their profitability? Is their profitability growing? Are their earnings growing, right? And then you have to say, okay, well, what do I think the future looks like for this company? Will demand continue? So you're considering a few different things. And, when you start looking at cheap that way, you start saying, okay, well, what can I buy as far as companies out there that are growing and doing well and not have to pay a lot of money on in terms of, we'll call it price to earnings ratio. Okay, how much the share is divided by the earnings per share that's expected. We'll use forward earnings.
Yeah,
And when you start looking at it that way, you find plenty of bargains that you can throw in the stockings.
this forward PE metric is a really handy way of saying, oh, wow, this stock is a bargain. And of course, there's more to it. You want to really dive in and do your research. Seems like a good time to throw it out there that, as always, people in the program may have interest in the stocks that we're talking about. Motley Fool could have formal recommendations for or against them. So do the research. Don't buy or sell just based on what you hear today. And in doing that research, definitely check out the forward PE ratio. So we're looking in this episode at 2016 earnings and the multiple that a couple of stocks are trading at for 2016 expectations. One that stood out to us, and this is really no surprise, we talk about this company all the time, Gilead Sciences, trading for 8.66 times its 2016 earnings expectations. That's pretty cheap, but why? Why is that number so low?
This is stock that you could argue is mispriced because people have continuously bet against it for the last year by thinking that competitors would come out and launch drugs that will challenge its leadership in the hepatitis C indication, and that money would therefore disappear from Gilead's revenue and profit stream, head to these other competitors. That has not happened. Vicarapac was a drug that was approved by AbbVie that launched in January. Sure, it's going to do a couple billion in sales, but last quarter alone, Gilead Sciences' two hepatitis C drugs were on a pace to deliver more than, I think the annualized rate, almost $20 billion annualized exiting Q3. So yes, there's competition, and we have to be aware of that competition. And there's some new competition coming. Merck and Company has a PDUFA date coming up, an FDA decision date coming up early next year. But few companies have been able to do a better job at insulating their market share against competition than Gilead. They've done it for years in HIV. They're already starting to demonstrate that they're having similar success here in hepatitis C. You've got a cheap company on forward price to earnings because people don't think they can continue to deliver the revenue and earnings that they have been delivering. And I think that might be creating an undervaluation that investors can take advantage of.
Yeah, I think as soon as Gilead can finally prove that they can overcome these competitive threats, which they have already shown time and time again that they can, but there remains this doubt in the market. And so as soon as people start to have faith in Gilead, which I certainly think is coming down the pike, that's when you should see, hopefully, the stock appreciate and become a great buy if you get in now.
Right, you look at it and you say, well, what's a fair price for this? Is it less than 9 times forward earnings, or maybe is it 12, or is it 15? So then if you take that $11, say, in 2016, and you put a multiple on it of 12, you can get a pretty good idea how much upside opportunity there could be for this company. And that's just if they can hold on to the market share that they have now. It doesn't have anything to do with, the other efforts to try and expand into other indications.
Yeah, this is a company with a very deep pipeline.